So what's the take for 2023? I think we need to start looking back at the end of 2020 when we said that inflation would have been around 2%, mainly for three drivers: green transition. Basically, if you don't want to pollute and you want to transform your current economic system, you'll have to basically spend more money, and short-term is inflationary. Secondly, some of the benefits of globalization and computing are now coming to an halt. And basically, the three effects, I think, were very visible, and then they got turbocharged by the war. In August, September, we published a piece, dive in, basically max risk on in fixed income in particular and in equity financials, with our simple view that rates in the US would have stabilized around 5 and in Europe around 3. Since October, we had one of the best market performance as finally inflation has de facto peaked September, October, November. What we do, we actually speak to company and look at the order book, and we try to gauge the price of the key materials, components, labor. And in this way, it was pretty easy to understand that inflation had peaked. October, November, December, every corporate we spoke was seeing month-on-month decline on anything they were buying. And this, I think, is the key advantage we have. What do we think will happen throughout the rest of the year? So first, I think there is too much complacency in the equity world. S&P earnings at 200 are more likely than 220 to 30. You see already corporates firing. The reality is revenue growth in the first half will be very weak, as most corporates are trying to go for a cost cutting because probably some businesses in pandemic, they overinvested, overhired, overspent. Secondly, China is back in business. The World Economic Forum, she sent one of its key ally, and the message was, whatever we had to do in 2022, we got it done, we're open for business, and we're back to where we were. I think we'll likely see throughout the summer a basically double top of inflation as China reopens. Let's be clear, if you have 1 million more barrel of oil consumed by China, that immediately spike most commodity up 5 to 10%. If you follow commodity prices, you're already seeing they're starting to recover. We're now halfway through peak to trough compared to 2022. Despite this, what we think, though, is that financial and fixed income markets are very positively positioned. And the reason is because the market is wrong on one assumption. The rates are going to follow in the next year. Because inflation will be more permanent. Forget the word transitory. We said was not only wrong, but factually, basically couldn't even demonstrate. I think this is now structural for a couple of years. Now, this is the best setup for financials you can have and you can dream.